Hopefully everybody had a good weekend. So we got a lot on the table this week between earnings and economic data. In the entire year, this week is one of the most pivotal weeks that you can come across, and it's also lightly traded. If you're newer to trading and you don't quite grasp the logic, in a light volume environment, you can get some of the most drastic moves. That ties into the logic that it doesn't take as much of a position to drive price. All right, so as we usually do, want to start want to take a look at what happened around the world. Asia's already closed, Europe is still open, and that should be the start of your focus every morning. Come in, try to get caught up on what happened in the overnight hours. And there's a couple of different ways to do this. I like to point out the ways that people can do it for free. Obviously, you get what you pay for. If you were to buy a news source, you would probably, get it faster, maybe have it presented to you in a better format. But if you're not yet profitable in your trading, spending money to get those different tools can be a little bit of a burden. Financial Juice, while I do recommend having an account there, it's free. You can get a free account and use it. The reason you would want an account is so that you can filter out some of the news, because it does have a lot of sources tucked in there, like MSNBC and just all kind of extraneous stuff that I don't really want. I don't think you would want. It would just flood it with more material than you would actually be interested in digging through. But this is one place where it shows who's on the docket to speak today. Now, due to the fact that it's FOMC week, we're in a media blackout mode. We won't be hearing from Fed speakers during that period, so there's not going to be anybody listed here. But it doesn't always have to be Fed speakers either. If the president is going to be speaking, he can show up on here, or different leaders around the world, if they're going to be speaking, they can show up in here. So it's a really useful, valuable tool. It's free. And one of the things that this tool does is it brings us this market wrap. When our markets close, it does one. So if you've seen a move during the intraday in our markets and you're trying to figure out like what the heck caused that move, come in here and read the US market wrap, try to get an idea of where that move came from. Same thing for Europe and Asia. This can be useful when we have contagion or carryover, right? If real estate and utilities are doing good in Europe, it's very likely they're going to do good when we come into our markets, right? So it's a good place to start. From this, lead right into Thinkorswim to get to this screen right here. Kind of think of Thinkorswim with multiple menus across the top. And these menus, the first one would be the top one here. And we want to choose Market Watch out of that menu selection. Then the second menu would be there. We want to choose Calendar out of that selection. bring up this screen here. If yours is really cluttered, say you just got a bunch of stuff showing and you're trying to weed through all of this, quickest way to get there is just turn everything off and then turn on the Econo Day event. These columns, you can move them around so you can put the description next to the time. And what we have on the docket today, 8:30, 10:30, 11:30, and 1. We have additional auctions, so we're not going to be expecting much of a lunch pause today. Keep your eye on that 2-year, and be mindful of the idea that we are in a inverted yield curve, and it's broadening out every day. It's getting more and more broad. When it first inverted a few months ago, everybody was going on and on about the fact that it is a precursor to a recession. As soon as they seen that, the R word started popping up all over the place, and we came back out of it. We didn't really stick in it that long, but we are back in it. We are fully in it. We haven't come back out of it, and it's actually broadening along the range. These additional auctions do not get a lot of attention. If you were to look them up, say on FX Street or other places like that, their anticipated impact within the market is usually shown as being very mild. And yet they are one of the key pieces that I use trying to catch V bottoms or catch reversals off the highs, even just recognizing that the potential is there for a V bottom or a reversal off the highs. It usually starts with me asking, what's the afternoon auctions list looks like. There are some that are more important than others, of course. The 2, the 10, the 30, those auctions, I pay, even more attention than the regular auctions, but watch the clock, people. The clock is one of the most beneficial tools at your disposal, and it's free. It doesn't cost you anything. I did do a video over the weekend, another video that gets thrown into the pile on how to think or swim. We went through a little bit of housekeeping and maintenance. Think or swim is just like a car that needs maintained, right? You rotate the tires, you change the oil, you perform maintenance on it, and your car lasts longer, it performs better. And when things start to screw up, you notice them quicker because you keep it clean and maintained. Think or swim's just like that. We're on a daily chart, the ES. I guess I don't need that note anymore. We're past 4 in the morning. I want to start with a daily chart, especially on a Monday. I've noticed that day traders don't go out to those higher time frames as much as you probably should, mistakenly thinking, well, I'm a day trader. I don't need any of those really large candles. And yet you get a lot of your perspective from out there. Last week, we broke outside the weekly expected move. And look at where we ended for the week. That green line was drawn on 7/15. And price stopped right on that thing. I think it missed it by a tick. And in a $3,900 product, getting that close to something 1 week out, that's pretty impressive. I guess it was a little more than a tick, but not very much more. These expected move lines do a really great job of helping us visualize and understand risk. Now we have a new box, of course, it's a new week. One thing that I like to do when we get the new box is compare it to last week. So you can see what I just did here. I took the box that I had drawn on the last week's expected move and I put it on this week's expected move. And what stands out is that last week's box is bigger than this week's box, which if we put that into like some plain English, is saying that the market makers reduced the volatility for this week. Now think about that for a minute. We've got some of the biggest names in the monsters of tech reporting earnings. We've got FOMC and we have GDP, and they've reduced the volatility for this week. I don't know about you, but I think that this expected move is going to get ran over significantly, and that the level of volatility depicted within the market is not true, inaccurate, missing the bigger picture. The indicator I have down here at the bottom is asking how far away from the 10-period daily moving average is price right now, and on average, how far does it get away from that 10-period before it tends to pause or stall or reverse and come back towards the 10. Think of the 10-period moving average on a daily chart very much like the center of a basketball court. The game can be played, but it all starts at the middle, right? And from the middle, one direction or another, we still come back to the middle. That's price with the 10. So when we're above the 10, how far away we get from that 10, and then when we do reach that distance, are we going to pause there, consolidate, let the 10 get caught up with us, or do we flip back around and move back towards the 10? Each market treats that 10 differently, which is why I built this indicator so that we can see for this particular market, what's that distance from 10 that becomes too far? And that's generally how I use it. Have we moved, quote, too far, too fast? The average on the ES for distance from 10, at least year to date, has been above 3%. If we get more than 3% away from that 10-period moving average, then we tend to pause or consolidate or turn around and come back to it. So asking that question in the last week when we had that really nice rally, did that move us too far, too fast? Are we ready for a mean reversion because of that? No, we have not moved too far, too fast. We still have room left to maneuver before we would consider that we're getting, quote, overbought. I hate that phrase, but it kind of fits. Speaking of the move that we had, it's also worth noting the swing highs and the swing lows. I've got that white line running from the upper left to the lower right on my chart. It's a linear regression line. So we monitor the swing highs and the swing lows. And right now, after having come off of this swing low, we started to present with a swing high Thursday and Friday. It's not yet a swing high. We need today's candle to definitively break and move to the downside, which would then give us a valid swing high, or we need it to continue to go higher, which would tell us do not mark this as a swing high yet because it hasn't come off of that high yet. That one down day on Friday wasn't enough. For an example of what that would look like, when the FOMC on March 16, we had that nice run. We started a little bit of a swing over, as if we were going to make our swing high here and move to the downside. And instead, we expanded just a little bit more first, and then we got our swing high. It's still going to happen one way or the other, right? Markets don't move in a straight line. They're always going to pull back and then advance and then pull back and then advance. It's what they do. It's why when we are already sitting at the highs, we kind of ask that question, what's more likely? That we're going to go even higher from there, or that we're actually going to turn around and begin to go back in the other direction? Most of the time, we would not continue to go higher there. Kind of like in our current state of affairs. That was FOMC back here. This is FOMC week. There is a thinkorswim indicator called cumulative overnight volume. It's what we're looking at down here on the bottom of my chart in cyan. It's only reading the overnight volume, and it just adds every new candle's volume to the previous volume, and it accumulates. It's just getting more and more and more and more and more. This is useful to try to figure out, just looking at a simple glance, how's the volume today? In relation to however many days you have on your chart, what's the volume look like today? It seems a bit light. That's what the volume looks like today. Not drastically so, right? This previous days, they ended at 9:30. It's, it's not even 8 o'clock yet. As we get closer to the open, we'll see more volume come in. So, it's not necessarily a done deal yet. I would be interested in what it reads at 9:30, but looking at it so far, it seems a bit light. It's an FOMC week in the middle of summer. Don't be surprised at the lack of volume this week and the lack of participation this week and the increased volatility this week due to the lack of volume and the lack of participation. So as we usually do, we want to game out the theory. We can only do one of three things: maintain the range, break to the upside, break to the downside. Inside day breakout, up or down. In our current situation, we are sitting in the middle of the day. So from yesterday's high to yesterday's low, that is our base case, our range scenario. The high of Friday was also the previous week high, so it is now more than one pivot point. If we were to break to the upside, we would need to get through the cash session. We would need to get through our own Globex high at the moment, then the cash session, which happens to line up really close with the Globex high, and then half an ADR at 40.08. The previous week's high at 40.16, and a full ADR at 40.50. Our current ADR is 2%. So, we're talking about an $80 move. And remember, that's not our extreme target. That would be a normal everyday if we just happen to get a nice, good, clean, normal bullish day. If things were to get wild and crazy, we would take that ADR and increase it by at least 50%. I will note that there's no market maker move this morning, so there's no anticipated increased implied volatility spike. For the downside, we would look to get below the daily pivot. Then the open from last night in Globex at 39.67, our own Globex low at 39.51. Then the low of yesterday, 39.40. The weekly pivot, 39.33, half an ADR at 39.27, and a full ADR at 38.86. Seems like a long ways down, I'm sure. There are some pivot points that you could carry forward to kind of fill this gap. One of them would be the Globex low from Wednesday into Thursday. Let's see what else we could find from back there. There is also the Globex high from Monday into Tuesday. the cash open of Tuesday. And cash open of Monday. So you can see how those added additional pivots between the half ADR and the full ADR. Remember that those are not handrails. They're not something that you would lean on. They're just areas where we would anticipate some reaction in price. Now, one thing of note, this is the top of the range, and this is the bottom of the range for last week's price action. And if we were to snap a fib line there, the drawback on Friday pulled back to the 38.2. That's a automatically drawn fib line. If we had snapped it the other way around, that would be a 786 or darn close to it. When you're looking at a trending market, and you get that pullback, and we're all trying to decide, is that a pullback or is it a change in market sentiment? The pullback shouldn't come back more than 786 before continuing to our next target, which is the 1236. That's how far we pulled back on Friday, to the tick, to the spot where it was supposed to pull back. It's where it stopped. So if you're thinking that Friday was the start of us rolling over and heading back towards the lows, approach that logic with a little bit of caution, because that pullback stopped exactly where a pullback should stop if we were only calling it a pullback. All right, we're looking at a 10-day volume profile here, 30-minute, 10-day volume profile. In blue, we've got volume by time, and in green, we've got volume by price. The one in blue is called a TPO. The one in green is called a volume profile. I know they look very similar, but they're measuring different things. One thing we want to note is that we're outside of the box. When we're outside of the box, we have an expectation that we're going to get back to the box. The value area low is 39.40. For us to make that move back down to the 39.40, there is a significant level of volume right in here. We would carry that forward, sitting between 39.64 and 39.54, just for some easy numbers, right? A little 10 handle. The TPO point of control is 39.55, by the way. I found that interesting. And we are pretty much too far away from the point of control on here for it to have any value, but it's 38.58. Here we're looking at a 5-day, 5-minute chart with a volume profile on every single day. Tend to use this setup the way that they teach volume profile, with their suggestion that we should carry forward yesterday's value area high, value area low, and point of control. And we take note when the point of control has yet to be touched. right? It's a untouched point of control or a volume aversion point of control. We have that from Friday. So we're looking at 39.96 and 3 ticks. That's going to be a significant level should we come up and retest that spot. You're definitely going to want to have that marked out because we have every expectation that there will be a reaction in price when we get to that level. There is a gravity point at 39.41, somewhere right around in there, not just the 11s. This is one of the newer gravity points that's been added. $39.31, there it is. So you definitely want to keep track of where that one is located. If we come down, we're very likely going to have a reaction in the market when we get to that level, right? As a gravity point, price tends to consolidate or amass at that level. When we get close enough, it gets drawn to it. It's the word gravity. And there's very often a reaction when price reaches that gravity point. There's gravity points all over the place. Most of them aren't confirmed at these levels, but that one is, right? So the other gravity points, the 11s that we talk about frequently, most of those are not confirmed gravity points. They're assumed gravity points, but that one's not an assumed gravity point. All right, the watch list that we're looking at is the top 20 names in the Nasdaq by market weight. The top 20 names is the Nasdaq, right? You don't need all 100 of them to kind of figure out where the Nasdaq's going on a day-to-day basis. So these names drive that order flow. The monsters of tech make up the top 6, but if you take the top 20, you at least get that diversification into different and various sectors. We got them sorted this morning by how much they've moved in the pre-market. One thing that Thinkorswim doesn't do is show us how much movement there's been in the pre-market until the bell actually rings in the morning, right? So what we want to do is we want to see it on the intraday and we want to see it on the daily. So we can get an idea of where we're at this morning. Because of that drawdown on Friday, we've got an R2G set up. Well, that was a sharp move. R2G. This setup is red to green. So you have a red day the previous day, and then you have a green day this day, or it's the anticipation of a green day this day. I tend to focus on these in a market that is moving to the upside already. Because if we just had day after day after day after day of, you know, a downward trend, then having a red day the next day doesn't really offer us much of an opportunity, right? We're looking at Apple. And here on Apple, we had that nice trend up off of the lows since June 13th, a little micro trend. We're back above the year-to-date VWAP. And on Friday, we had that pullback back inside of the weekly expected move. This leaves us set up today for a red to green. One of the criteria for that red to green setup that I like to use is that we're going to open this morning at least as high as we opened the previous day. One, that previous day's open can become a minor support level. So if we open above it and we start to fade a little bit, the idea would be that we would bounce off of that and continue our move to the upside. But if we've gapped up in the pre-market, but we're not yet above that, then we still have that as an overhead resistance. In the Globex, we often move through those levels of resistance easier than we would in the middle of the day. So I like to get at least as high as that. You still have a benchmark of the previous day's high to get through as well. And depending on how strong the red to green is, you may have already opened above that level, and that would become the temporary support before the move up. Red to greens offer typically around a 4% move or more, because you have to think about if markets take the stairs going up and the elevator going down, usually the down day is a significant size day, right? Generally is pretty wide in comparison to the up days that came before it. And if we're talking about taking all of that back and then getting above that, then we're going to need a pretty high change of market structure, right? And then I need a ROC, rate of change, at a significant level. Now, the monsters of tech generally all move the same. So if we have a red to green in Apple, we very likely have a red to green in all of the other names too. For an example, Tesla. Tesla hit the bottom of that gap on Friday, took that soft rejection, and it was a soft rejection. Pulled back and closed above the previous day's close. Not by much, but it did do it. It needs to hold that. And then also we have that red to green play where we want to open at least as high as Friday's open and then get that rally to the upside. A rally to the upside would put us inside of that box, that gap. So overhead resistance, 836.45. Should we get through that, gravity should start to take us towards 865.65. Amazon, red to green, hasn't even come close to that 130 box. We did get into a level of resistance at 125 where we took that rejection from Friday with that last little hurrah, right? That blow off top play before the move down. Red to green setup. We have the potential to open at least as high as the previous day's open. Keep in mind that with Amazon and a lot of these other names, you've got a lower TRB, trendline break setup. Anybody else having issues with audio? No? Guess it's just you. The Zoom is doing really good. It just seems to be audio issues on the YouTube side of things. may have to figure out some other way to stream these live to YouTube rather than using Restream. Restream seems to be the issue. Might have to go back to OBS Studios. So with these FANG names, they're all basically going to have the same setup. Red to green, lower TRB, overhead resistance, but not Google. Now, Google by market cap is big enough to crack this market in half. It's one of the biggest earnings events that we have on the agenda this week. Facebook's no longer big enough to break the market, but Google most certainly is. We do have a red to green setup here, but Google wasn't in an uptrend like Amazon or Apple, right? So the idea that you have a red to green here, I wouldn't focus on this as an intraday play. The red day is massive compared to its counterparts, its previous days. It wasn't in an uptrend. So I'd let that one ride. Try to focus on other names. Tesla, if you think about the opportunity to go short, if we do get a short today, Tesla is one of those that's ran the most in the last few days. So, often the ones that have ran the most have the most to fall. If I'm looking at shorting this market, I'd rather short something like Tesla than Google. Google is already sitting at those lows. Tesla's sitting at the high of the range at this little micro cup. So keep in mind, the only reason that we're even talking about anything bearish at all is because of the really bad economic data that we're anticipating and because of the FOMC meeting. If it wasn't for that, the patterns and the charts right now are telling us that this long still has room to move. Bear market rallies can last well beyond a 10% move. And by no means do I think that we're done with these lows. The S&P is more likely to see 3,300 before it sees 4,300. But we could continue to sustain the move off of these lows. We just have to survive this week. Microsoft as well had that red to green. Again, I like to find these in a market that was in a decent move, in a decent trend at least, right? And we had the early part of July here, a nice little run up, but comparing that to say what we've seen in Amazon or Apple, Microsoft doesn't look very good either. Facebook, we had that break of the range. We actually closed one of those gaps. Rejected on the year-to-date VWAP and just got smacked right back down again, all the way back down inside the box. It didn't Didn't test or rest on top of that box at all. PayPal closed the gap. We got a red to green here. And we've got a reasonably decent support level. One is the year-to-date VWAP. Two is the bottom of that gap, that 80.43. Just remember that the chart patterns is the last thing that we would look at, right? If we're looking for a trade and we're looking around at the opportunities presented, the very last thing we would use is the chart pattern that we have. Price action would be our last decision process, not the first. So if you're looking around for trade opportunities right now, price is the last data point. All right, so I'm looking at Netflix here. We haven't completed the bigger cup, but there was a little micro cup from early June. Had the earnings, nice expansion out of it. Red to green. And again, this red to green, I like to find it in a trend. What we had in the last 7 days, that's not trend. That's impulse. So even if we were to get above the open, we've still got the institutional pivot point from Friday or from Thursday. And then we've also got the high of Friday to deal with. And that's a very large day. It's a very, very large range. So this could definitely offer some opportunity to trade, but I don't expect an inside day breakout to the upside here. If this is going to continue to maintain and stay healthy and then grow from here, the benchmark is going to be that we stay above that 217. It's very likely we're going to see a Busby, which would be the idea that we come down and retest 205.5. If we think about linear regression, that white line that's running on the chart, and those swing highs and swing lows, let's put it back on the right time frame. So year to date, we're due for a swing low at this point. So we would expect this to be our swing high and that we pull back and we actually set a higher low. And if we're going to look for a longer term swing in Netflix, we want a full set. A full set is 2 higher highs and 2 higher lows. We don't have that yet. For a swing trade, this has the potential, to move 100% of its current price, right? As a swing, this thing has got the potential to really recap some old price ranges. So there's no reason to jump in early if you're looking for that kind of swing. Just keep your eyes on where the resistance is at. This cup bottom, 244. That little micro cup top, 205. And keep in mind that we're due for this to be a swing high. It owes us some form of a pullback before continuing on, if this trend is going to continue. It's my day to stream today, guys, so I will be inside the chat room, stock and options. And I'll figure out what to do with this live stream onto YouTube today. I think we're just going to have to use OBS because the day after day complaints about the audio quality on YouTube, it's obviously not, it's not doing a good job. So I'll see you all at 9:15 in the Discord chat.